Hi, Joe Kehrig with the Kehrig Real Estate Team, and this is your San Ramon Valley update. So, if you've been reading the news, you'll see that the United States credit was downgraded, in the world. And how does that affect interest rates, and how does it affect our economy overall? Well, it does affect interest rates, because what happens when your credit is downgraded, when you're a nation, to sell basically the loans to other countries, you have to pay a premium to sell those loans when your credit goes down. So what it means is they have to jack up the interest rates, and that's what we saw. So the credit rating was downgraded for the United States, which meant the interest rates had to go up because they have to pay more to sell those loans. So now we're sitting there back around 7% or so at the peak, which was kind of the peak the last year. Now, a couple of years ago, it went all the way up to 8. But it also then went down to around 6, and now we're back up around 7. But overall, what does that mean? Well, first off, the Federal Reserve, the last time they met, basically passed on lowering the Fed rate. Now, the Fed rate doesn't directly affect the mortgage rates. It does affect HELOCs, car loans, credit card interest, but it doesn't directly affect mortgage rates. But there is a ripple effect, obviously. So normally when you see Fed rates go, not all the time, but normally when you see Fed rates go down, you'll also see, interest rates go down. Well, expect to see, because with basically the economy slowing down, partly because of the tariff situation, of the credit rating score, the credit rating of the United States, expect to see the economy slow down. And this is what the Federal Reserve does. So the Federal Reserve will sit there, if they need to spur the economy, like we're going into a recession, or we're in a recession, they'll lower the interest rates to spur the economy. Now, what happened a few years ago when inflation was going nuts, well, what they do then is they raise the interest rates to tamp down the market. So as the economy slows, which we're starting to see it slow, expect the Fed to cut the rates 3 to 4 times probably for the rest of this year. That's what the experts are saying. So when we have a recession, you see interest rates go down. Matter of fact, in all 6 of the last recessions, interest rates have gone down. And what happens when interest rates go down, the last 30 years, prices go up, with our real estate prices. Only 1 year, 2008, did we see basically prices go down when the interest rates went down and the economy was in a recession. In 1991, we saw it stay about even, but 4 of the last 6 recessions, real estate prices actually went up as interest rates went down. So overall, as the economy slows, which it will with the credit rating and such forth, and that's why they lowered the credit rating in the United States, because the economy is soft, you're probably going to see interest rates go down. Hence, you'll probably see prices go up. So that's kind of what's going on. Now let's look at what's happening in our local market. First off, look at San Ramon. You see the pending sales have gone down, but what we're not seeing, which we normally do across all the cities that we monitor, we haven't really seen the inventory climb. It climbed for a while, and then the market started to pick up, so we have a lot of pending sales. So you can see there's actually one less active property in San Ramon than there was, last week. Danville market. Well, you only see like 3 additional active properties, but 3 additional pending. So that's staying pretty consistent. We're not seeing inventory, jack up. Alamo, you did see inventory go up from 43 to 52. Pending stayed about the same. And in Dublin, barely 147 compared to 144 last year. So you're seeing a little increase as far as, the overall active properties, but not a ton. The market is pretty stable. We're going to have a lot more sales this year than we did last year because there's so much more to choose from. This is a great time to be a buyer out there because, yes, the rates are high, but we always talk about marry the home, get the home you want where you have lots of choices, and then basically date the rate. And when the rates go down, dump that ugly rate. Because the one thing that you'll see, if you're a seller, with the added inventory, you do have to come out of the market really hot. You got to come out of the gate, because the homes that are selling, when you look at the pending sales, they're all selling within a week, and they're all selling, as you see, at 100% of asking price. But the ones that aren't selling are staying on the market for 30, 60, 90 days and have to do a lot of price reductions to basically have the best opportunity to even get in the market and be able to sell. So if you have any questions and you just want to meet for a consultation, because what we'll tell you is, hey, where is the market right now for your home? What do you have to do? Because sometimes spending $25,000 can get you $100,000 in return, because the home has to show nice, it has to be priced right to have the best opportunity to sell in this market. So any other questions, give me a call, Joe Kehrig, cell 925-487-6838, or drop me an email, joe@kehrigteam.com. If you want to learn more about the Kehrig team, go to www.kehrigteam.com and take a look at all the properties we have. We have a lot of great opportunities out there for you. But again, if you want some expert help and you want a real consultation, then give us a call. Market's very fluid. You're going to see changing week to week, so make sure you tune in next week. Have a great week.